Good afternoon, everyone. Welcome to the 15th Annual Julis-Rabinowitz Center for Public Policy and Finance Conference. The theme of this year's conference is Debt, Deficits, and Global Imbalances. I'm really looking forward to the really brilliant speakers that we have in all of the sessions. Luckily, I'm not speaking in any of the sessions, so I really expect a high quality and looking forward to all of the brilliant minds that I've gathered to talk about these topics, which are obviously important topics given the times that we are living in. This year is also the 15th year of the center, so we will be celebrating that as well. We'll have more to say on that at the reception that will come right after this session. Let me introduce the moderator for this session, who will take it from here, who's my colleague, Markus Brunnermeier. Markus.
Thanks a lot, Atif, and thanks to all of you for coming to this great conference. So I have the honor to chair the first session. And I guess introduce all three speakers from the beginning, then we can make a quicker switch over during the talks. So the first speaker will be Emil Verner. And if you look at the program, there's a little star next to his name. That means he's a graduate from Princeton. He's a PhD student from here, but he's from MIT, professor of finance. And he will talk about everything is solvency, nothing is illiquidity, something like that. Then Şebnem, Kalemli-Özcan. She is from Brown University, the Schreiber family professor, and I think you're also taking over some center soon. She will talk about capital flows, global imbalances. And then Sumit Agarwal will speak. He's coming the furthest. He's coming from NUS, National University of Singapore, and he's a Kwong Distinguished Professor at NUS. So I think I should not waste any time, any valuable time from the speakers. So I think, Emil, you're first, and then we go from there.
Thanks so much, Markus, for the introduction. Let me just say, so I remember this conference as a PhD student. I think the first one I went to, okay. Opening remarks, Atif. The session, here we go. The first conference I went to, there was a pretty spirited debate between a former Treasury Secretary and a very prominent Princeton professor about whether the boom in China was going to lead to a subsequent debt-fueled crash. So I'll let you guess who the protagonists were and who was right, but I think it's an example of kind of the important topics that this conference always raises. So I'm going to talk about financial crises and the roles of solvency and liquidity. Financial crises are obviously extremely important. If we want to think about major economic downturns, these are often associated with financial crises. They have very large economic costs. And a central aspect of financial crises is the impairment of the banking system. So that raises the question, what are the causes of banking sector distress during crises? So let me lay out sort of a pretty stylized, maybe you'd say caricatured view of how to think about sort of two views of crises. One view puts panic runs or illiquidity sort of center stage. It says that runs are these crucial turning points that you can think of perhaps as jumps to bad equilibria, and without these runs you wouldn't have such severe downturns. So sort of illiquidity leads to insolvency. If you read Friedman and Schwartz, for example, their account of the Great Depression, it has kind of very much this flavor. I think at the other extreme, another view, I'll call the solvency view, puts a lot of emphasis on bank losses that put financial institutions toward insolvency, and runs occur as a response and potentially amplify these deeper solvency problems. So in this view, sort of insolvency, begets subsequent illiquidity. Now, we know and we teach in second year Princeton finance that these views aren't mutually exclusive. Liquidity and solvency, of course, interact. But understanding the relative roles and sort of how to think about these two dimensions is pretty important for both the right theories for thinking about crises and also for policies to intervene in crises. So in my talk today, I'm going to put forward, I think, maybe a pretty stark thesis, which is that really the way to think about most financial crises in the banking system and most bank failures is that they're typically caused at root by deteriorating fundamentals that push banks toward insolvency, and costly runs result as a consequence of these deeper solvency problems. And I'm going to marshal two sets of evidence for this hypothesis. The first is going to be a range of bank-level microdata evidence that I put together from the pre-deposit insurance US banking system. And then I'm going to close at the end with some complementary evidence from international financial crises around the world, especially over the past 60 years or so. So let me first start by talking about this pre-deposit insurance banking system evidence. And I'm going to spend a lot of time on a paper that my colleagues Sergio Correa and Stefan Luck and I have just released called Bank Runs with and Without Bank Failure. So the setting is the US banking system from 1865 to 1934. This is sort of a historical laboratory before the introduction of insurance and before a public lender of last resort for the period up to 1913. And what we do is we put together a new bank-level data set of bank runs. This is how we do it. We read 250,000 newspaper articles that talk about banks or distress in the banking system. Or rather, we have large language models read these articles, and we identify over 4,000 bank runs that affected individual banks during this sample. So on the right here, there's an example, for example, from a run on the Knickerbocker Trust during the Panic of 1907. At the bottom, there's an article about the run and failure of the Bank of the United States during the Great Depression in December of 1930. And there's thousands of these other runs. And we're going to merge this with data that we've recently digitized on bank-level fundamentals. So all of these runs you can actually go read about at finhist.com/bankruns. You can search the city that you're from. This morning I was searching Princeton, New Jersey. It turns out Princeton was kind of a quiet place when it comes to financial crises. It was, most professors, I guess, were writing papers rather than running on their banks. If you go up to New Brunswick, whole different story. Lots of bank runs there, and you can read about all these different episodes, including how the runs were resolved, whether they led to suspensions, whether they led to failures, and what the newspapers otherwise said about these runs. So this is the time series that you get from this exercise. So this is showing the rate of bank runs, the rate of runs without failure, and the rate of runs with bank failure. And what you see is sort of what you would hope to see. Spikes during the famous panics of the national banking era, as well as the Great Depression. And some of these panics have lots of bank failures, like the Panic of 1893 or the Great Depression, and others don't. So then we can start to ask some basic questions like, which banks are actually the ones that are subject to runs? Are runs sort of random? Do they happen mostly to weaker banks or just to strong banks and weak banks alike? And what you find when you do this exercise is if you sort banks by a simple measure of their fundamentals, which is based on some earlier work that we've done that captures the probability of default quite well, so based on bank capitalization, recent profitability, and reliance on non-core funding, what you find is that banks in the bottom decile are much more likely to be subject to runs than banks in the top decile of this fundamentals, right? So I think this is not too surprising. It's consistent sort of at a basic level with theories of fundamental-based panic runs. But at the same time, every now and then, even strong banks can be subject to runs. So even banks in the top 10th decile of fundamentals have something like a 25 basis point chance of being subject to runs. Why is this? Well, in the paper, we show that sometimes there's bad news, maybe a run on another bank or a decline in the stock market, and that leads to some depositor confusion that leads to runs even on good banks, kind of consistent with these theories of asymmetric information-based runs. Now, you might ask, which of these runs actually lead to bank failure, sort of to one very costly outcome of the runs? So on this figure, I'm plotting what is the likelihood that the run results in bank failure. And so what you see is for banks in the bottom decile, there's about a 60% chance that if you're hit by a run, you're going to fail. Whereas if you're in the top decile, it's much closer to zero. It's around 8% or so. So in other words, what this says is that runs are more likely to happen in weak banks, and also conditional on the run, you're much more likely to fail if you're a very weak bank. Strong banks rarely die from runs. Another implication that we show in the paper is that runs have a little bit more of an element of randomness. Failures are quite predictable based on weak fundamentals, whereas runs are somewhat less predictable. So you might ask, well, how do banks actually survive runs? How do they respond to runs? And so again, we can go and read the newspapers or ask LLMs to read the newspapers to give descriptions of how the banks manage runs. And so you get lots of interesting responses that are quite intuitive. The banks that survive runs, they're more likely to accommodate withdrawals, to borrow from other banks, to try to send public signals to depositors, like putting a cash load, truckloads of cash in the windows. Sometimes the owners will inject equity, and in very severe runs, banks will suspend convertibility and often have bank examiners, say from other banks or from state or federal regulators, come in and check whether the bank is actually solvent. In about 10% of these runs, a bank clearinghouse is involved to somehow try to figure out whether the bank is solvent and also to provide liquidity. I think this evidence is quite intuitive and consistent. And given that we are in Princeton, I felt I would be remiss not to put a picture of Jimmy Stewart in the film It's a Wonderful Life, where he precisely deals with the run by trying to convey to depositors and persuade depositors that the bank is actually not insolvent at that time. So these results are quite intuitive. So I haven't yet answered the question of whether runs trigger the failure of weak but solvent banks or of fundamentally insolvent banks. This is a very hard question. We're going to try to make some progress on this by looking at recovery rates of banks that ended up failing. So one fact that's quite interesting is in these pre-FDIC failures, the asset recovery rate for national banks was pretty low, about 52 cents on the dollar, consistent with sort of asset quality being quite poor. So then we can make some additional assumptions about how much value is destroyed from failure itself. In particular, how much value is destroyed from receivership, so due to liquidation, and how much value is destroyed through loss of franchise value. And then we can basically have the simple condition that says, a bank is fundamentally insolvent absent the run if the recovery rate relative to its leverage, its debt to assets, is sufficiently low, sort of adjusted for these two terms of how much value is destroyed by the run. The intuition is pretty simple. If you have a very low recovery rate, it suggests that you were probably fundamentally insolvent, even absent the run. Whereas if you were subject to a run and your recovery rate ended up being pretty high, then it seems more likely that the run actually caused you to fail, even though you were solvent. So here I'm plotting the share of banks that were subject to a run and that were fundamentally solvent under different assumptions about how much value is destroyed in failure. So these rho and v measures. So if you assume that no value is destroyed in failure, then that number is something like 7-8%. So only about 8% of failures would have been on runs on fundamentally solvent banks. If the run and the failure destroys about 20% of value, that number rises to something like 20%. So I think another way to say what I've just said is the scope for runs to cause failures of fundamentally solvent banks is probably modest in the sample, but it's not negligible. It's not that it never happens. But what it also tells you is that many of these banks are pretty insolvent, very weak, when they're subject to runs, which suggests that runs actually probably happen quite late, kind of once these banks are already in trouble, consistent with actually this notion that depositors are often pretty sleepy, not monitoring their banks before it's too late. So you might ask, we're standing here almost 100 years later. Is anything that we're saying consistent with what contemporaries thought on the ground? And it turns out there's quite detailed records of national bank receiverships with information on what the receivers, the bank examiners, thought at the time of failure. So the figure here I'm showing on the left shows the asset quality assessments by OCC National Bank examiners. So in banks that failed, when the banks suspend, they evaluated that about 35% of these banks' assets were actually good. They use very simple language. Another 47% they thought was doubtful, and about 18% they said was worthless. These numbers actually predict recovery rates very, very well, so they're quite informative. The OCC would also give their cause of death, why they thought the banks failed. And common explanations are losses, local economic downturn, fraud is a major story. Runs are given as the cause of failure in less than 2% of these bank failures, even though many of these failures involved large deposit outflows and involved runs. So it seems like many of these contemporaries saw these sort of fundamental insolvency problems as playing a central role as well. So then we can go and ask, okay, what is the consequence of these different types of bank distress episodes? So now I'm going to aggregate this data that we've collected to major US cities for this sample. And I'm going to look at the following three types of bank distress events: runs without bank failure, runs with failure, and failures without runs. And then I'm going to look at what happens to local loans and also local real activity. And what you find is that runs without failure, these episodes that look more like liquidity events where the banks are not fundamentally insolvent and not driven to insolvency, these are more benign in terms of their declines in city-level loans. And the same if you look at city-level manufacturing activity, which we have at the weekly level for 29 cities. On the other hand, if you have a failure without a run, actually that's pretty bad news in terms of local lending, and also local economic activity declines by about 5%, so a 5% decline in industrial production. And then the worst outcomes are these failures with runs. So if you have a failure and you're subject to a run, that's the biggest decline in lending, the biggest decline in industrial production. But really the difference between failures without runs and failures with runs is perhaps not as stark as you might have expected. So all of this evidence I've shown you so far is from this period in US history before deposit insurance. You might ask, well, how is this relevant for today? Now we have all of these different institutions that are meant to forestall run, deposit insurance, public lender of last resort, other ad hoc emergency liquidity facilities. So how does that matter for how banking crises play out? So in some work I've done with Matt Barron and Wei Shang, we looked at this across 46 countries, going back to 1870 to the present. And we classified banking crises into 3 sets. Banking crises that involve panic runs without clear solvency crises, where we defined a solvency crisis as if the bank stock index declined by a lot, by 30%. So a panic without a solvency crisis, that's again like the panic of 1884, for example, where there's lots of runs, but ultimately it turned out to be a liquidity issue, not a major solvency issue. Then we can look at solvency crises without panic runs. So these are episodes where, for example, policy forestalls runs, but there's evidence of widespread insolvency issues in the banking system. That's like Japan in the early 1990s before the runs later, or the US in the early 1990s, Canada in the Great Depression. And then finally, we can look at solvency crises with panic runs. This is maybe sort of, in terms of your hierarchy of crises, these are the full-blown crises. And what you see is that episodes that are sort of pure liquidity episodes, panic runs without solvency crises, are much more benign in terms of their real GDP response, in terms of the evolution of credit to GDP. Solvency crises without panic runs lead to contractions in GDP of about 2%, and solvency crises with panic runs are the most severe episodes with declines of about 4%. So what this is telling you is that these runs are not necessary for severe outcomes, but it does look like they're making things worse. Lastly, and I think I'm almost out of time, let me just talk a little bit about where do these solvency crises come from. Sometimes there's shocks that are bolts from the blue. But often kind of what the literature has shown over the past few decades is that these rapid expansions in bank credit to the private sector, that's one of the best predictors of crises. And so here's based on some evidence that I've put together with Carsten Muller, who's going to be presenting tomorrow, looking at credit booms in the run-up to major banking crises, so 59 banking crises in 90 countries. And what you see is that these banking crises are often preceded by these rapid expansions in credit. And the credit is especially flowing to households and to firms in the non-tradable sector, like firms in the real estate sector or other types of non-tradables, right? And so that's sort of consistent with this idea that these credit booms are often what sow the seeds of subsequent losses and solvency problems. And why is it these particular sectors? Well, these are often the sectors where collateral feedbacks are important and where domestic demand feedbacks are very important. And that allows these booms to sort of take on a life of their own that becomes disconnected from economic fundamentals. So let me just wrap up. Now, I've tried to argue that a first-order way to think about banking crises is to think about fundamental solvency problems as being at their root. Runs typically follow as sort of a consequence of those deeper solvency issues. They're commonly the trigger of failures, but they're not necessary to have severe outcomes. And if you have runs without weak fundamentals, these are actually seem to be less costly because banks have other ways of managing these types of episodes. And credit booms are important precursors of these solvency issues. And finally, given that this is the Julis-Rabinowitz Center for Finance and Public Policy, let me just mention kind of briefly policy implications. We actually have a range of evidence that's building now from different case studies and also international evidence that efforts that focus just at liquidity provision during crises are often not enough to stem their crises. And that's exactly the conclusion that you would draw from this thesis that I'm laying out in this talk. So thanks very much and look forward to the questions.
Okay, thank you so much for inviting me to this amazing conference. And I'm going to have comments based on various papers with different co-authors. So some of them are in Federal Reserve system, ECB system, and IMF. So I have to put the usual disclaimer that these are my views. And because the task assigned to me in this session is credit cycle and financial crisis, I'm going to start where actually Emil left, which is also a long-time passion of mine in terms of understanding how all these issues, and we'll talk about financial crisis, banking crisis, things happening in the financial sector affects the real sector. How do we connect the finance to real side? How do we connect the financial issues to the real side issues? And of course, to be able to have a precise view on that, you do need to work with firm level data, which is what I have been doing now for a long time. So let me start there, and I will move on to the international. Links between corporate debt, savings, and macro in general, and then going from there to international and global imbalances. So these links, if you want to, link the finance to the real side, is it going to go through corporate debt, firm debt? And it's going to come through first, basically linking the crisis to boom-bust cycles, where corporate debt is going to play a very important role. Second, the balance sheets, the corporate balance sheets, firm balance sheets, and the contract types. How do firms borrow? What type of contracts they use? What type of collateral they use? How interest rates vary, and so on. And finally, the international dimension is going to be connecting these firm-level phenomena to aggregate international phenomena through capital flows and both international and domestic portfolio allocations. So a few insights from several papers, different papers. First, corporate debt dynamics is going to be very important and directly linked to global imbalances. First, we realize this by looking at the firms in Asia, but it is broader than, of course, Asian firms. You can definitely expand it to, Europe, America, and Latin American firms. There's going to be a direct link between the two. Second, once you view this both domestic and international debt, of course, the currency dimension is going to be very important. You can borrow in dollars, euros, or pesos, and that type of FX mismatch is going to be a major driver of financial crisis, especially in emerging market economies, but it's also going to affect the transmission of global financial cycle phenomena and also U.S. monetary policy to other countries. Then corporate debt is going to impact macro aggregates. And macro aggregates, I want to emphasize employment here. It's going to be it has an important role on the employment side and also investment and output and linking boom-bust cycles and financial crisis. And finally, the aggregate employment and investment outcomes are going to be actually more linked to the smaller firms debt, SMEs, small, medium enterprises, than very large corporates. And that's because of the debt contracts. They are borrowing with very different type of debt contracts, large firms and small, medium enterprises, and that's going to have a direct link to aggregate outcomes we care about, such as employment, investment, and output. Okay, let me start with this beautiful figure. This is actually from Emil and Karsten's work. This comes from my joint paper with Karsten and Victoria Ivashina and Luke Levin. So this tells you how important firm debt is, both in advanced economies and emerging economies. You can see non-financial firms being the dark purple, and is it as important as household debt in advanced economies, and it's more important than household debt in emerging markets. Now, what we did in our work with Karsten is actually look at what happens before the banking crisis, before and after, in terms of credit growth. And we kind of decompose the debt and in the credit growth, the household in blue and the firm debt in purple. And you see that firm debt grows together with household debt before the crisis. And then after the crisis, of course, there's this deleveraging, and that's going to have a huge impact on the sluggish growth, sluggish investment, jobless recoveries, all those phenomena we observe after financial crisis. Now, we do a prediction regression in that paper when you can predict the probability of a crisis. And here, again, we are relying on this amazing data set, both Karsten and Emil put together, and Karsten has another one with Chenzi, where we can condition on the household debt, predict the probability of the crisis. And then you can see that firm debt is going to be a very strong predictor of crisis, especially in the short horizon, 1 year, 2 year, and 3 year. And after that, household debt is, of course, also very strong. And here, if you want to look at the magnitudes, one standard deviation higher from credit growth, from debt growth, is going to increase the probability of a financial crisis by within the 3 years up to 3 percentage points. Then we also look at the non-performing loans, because when you look at non-performing loans, actually, interestingly, they are going to also happen in household sector, but most of them, when you look at these extensive episodes of banking crisis, they are going to happen in the corporate sector, in the firm sector. So you can see again the blue household debt, purple the corporate debt. They are kind of non-performing loan ratio is similar during normal times, the first two columns. When you look at the crisis times, this is the peak of the NPLs, non-performing loans. You can see that firm credit, the non-performing loans coming from the firm side is going to be very, very important compared to the ones coming to household side. Okay, so hopefully, I convince you right now that when we think about like financial crisis, banking crisis, we really have to think about the corporate debt, firm debt, and how kind of those events together is going to impact the real sector. Now, you come to the real sector, meaning investment employment outcomes. There, the debt contracts is going to make a big difference. And of course, Nobu's work and Atof's work is going to be very important, and we build on that by using a brand new data set from the Federal Reserve. So Federal Reserve Y14 data sets tell us actually how do firms borrow in the United States, all the firms. And then we are going to test this by using very similar data from other countries, including Spain, Portugal, Germany, Turkey, Chile, Colombia, and Uruguay. So it's not actually something that is common to the United States. In fact, we are surprised that we see this phenomenon also in the United States, because the sense that the United States has not that many small firms and bond markets are much more deep compared to, of course, the other countries. So we shouldn't be seeing a similar pattern. But in fact, we do. So how do firms borrow? So this is from Y14. This is exactly the contract. I'm putting this from the contract as U.S. credit facility have CNI. CNI is all the commercial and industrial loans. As you know, it's a $4 trillion market. So it's basically all the firm borrowing. So that type of a loan secured by different type of asset. And then, the company borrowing is going to report for each security with an integer. Integer is going to be from 0, 1, 2, 3, 4, 5. 0 is saying I'm securing this loan with real estate only. 1, I'm securing this loan with cash and marketable securities. 2, account receivable inventory. 3, fixed asset, excluding real estate. 4, blanket lien. Now, there's this phrase in the contract that says this should only be used for loans that give the lender a lien of equal seniority access to all unencumbered assets of the borrower. So basically, this has property rights in it, all sorts of intangible capital, blanket lien goes over, and then 5 unsecured. So you borrow without putting any collateral. Okay. Then when we plot this across the U.S. firm size distribution, you can see on the top, I'm going to start with small private firm, medium private firm, large private firm, and the bottom, now I'm moving to the public listed firms, small public, medium public, and large public. And you can see from the color code that the smallest firms in the country are the ones that use real estate most. That is the orange. But they also use, green and light blue, which is account receivable type of collateral, and blanket lien type of collateral. All these boxes are up to 100, so you can see up to 70% of the borrowing collateralized by these type of things that are not real estate for small firms. You move down the size distribution for the private, real estate disappears, and then the account receivable and light blue blanket lien stays the same. You come to the public firms, now you go to the Amazons of the world, to the very large, everything is unsecured, that is the dark blue. Okay, so we argue that this is going to have very important implications when you connect the financial side to the real side, especially when you think about an SME. This is a typical SME in the United States, small, medium enterprise, defined as sales and assets below 10 and 50 million. And you see that a typical SME in the United States is going to borrow largely using collateral, account receivables inventory in green, and blanket lien in light blue. So how does this square with the flow of funds? So flow of funds is going to tell us that when you look at the non-financial corporate business category in flow of funds, these are the really large corporates in America. They are going to be borrowing with the market debt, right? So that's the blue line. You see up to 70% of the borrowing, this stops before by COVID, is market debt. But is that's the bond market. And the bottom two, black and red, is going to be the bank and non-bank. Now, you look at smaller firms, non-financial business series in the flow of funds, you kind of start seeing like equal share of these type of borrowing. But of course, this is aggregate data, so you cannot really understand the granularity and heterogeneity. But that is important because when you look at the firm size distribution in the census data, you see that there are a lot of small, medium enterprise in the US. This is census data, firm size distribution based on revenue and employment in green, and CompuStat data, publicly listed firms, is in red. So what you want to do is like to observe this blue which is a combination of private firms and the public firms that borrow, because some of the firms in green might be just too small and they might not be in the credit markets at all. They may not be borrowing. And here we do the firm size distribution with the Y14 data, and then to compare, we also do the syndicated loan-based one on the right with green. So you see that firms who borrow in the syndicated loan market are going to be very, very large. In fact, they're exactly the same sample, very similar sample to the CompuStat firms, which are in blue. Now look at the Y14 firms in red. They are going to be very, very small. You can see the bulk is going to be with assets less than 10 million. All right, so what does it mean? Well, first of all, these firms are bank dependent. When you look at the SMEs, you see that especially the small part in that small, medium, large category of the Y14 data, the top line, 100% of the balance sheet is bank debt. These guys are not in the bond market. These guys are not in the stock market. They are private firms. They are basically borrowing from the banks. That means also, depending on the conditions of borrowing, you can see that they are paying a much higher interest rate. The red line is above the blue line in the first figure, and they are almost always collateralizing their borrowing. The smallest one, the dotted red, and the small ones in general, the solid red, almost everything is collateralized on the balance sheet. Whatever bank that they have, these small, medium enterprise in the United States, they are collateralizing that. Compared to who? Compared to large public firms or even the small public firms. And this is going to affect the monetary policy transmission. So here I'm going to show you impulse responses of a typical 1 percentage point shock to Fed funds rate. And that is going to tell you that, okay, what happens to leverage firms? Well, leverage firms is going to cut borrowing. So you are seeing the reduced borrowing up to 10 quarters. And also they are now going to be faced with a lower spread because they are just not borrowing. But who are these firms? They are actually the high leverage private firms, not high leverage public firms. In fact, monetary policy transmission is solely driven by the high leverage private firms that are really responding to the fluctuations in monetary policy. Same with the loan responses and same with the spread responses. Okay, so how does this link back to international dimension? The international dimension is going to be direct, next pass of this picture, because the emerging markets borrow through banks, right? So this is Turkey, and on purpose I plot until 2013, because after 2013, Turkey went on this very crazy unorthodox monetary policy, and also that's a period we stopped trusting the data. But up to 2013, it is a growth period. It is actually the second fastest growing emerging market after China during this period, like yearly growth rates of 8%. And also there was an IMF program on the table from 2003, because that's the period after Turkish financial crisis, triple crisis, banking crisis, sovereign crisis, and balance of payments crisis. So this period of 2003 and 2013 is like a textbook emerging market growth for Turkey. And you can see how little financing, international financing in terms of portfolios, hedge funds, non-bank financial intermediation and all that. And then the black one is the large one that shows you 40% of GDP is what domestic banks in Turkey borrow from outside, okay, internationally. And you can see the fluctuations here where, I'm plotting the capital flows, just capital flows in Turkey, and how the median domestic bank's non-core ratio moves with that. It's going to be very high correlated. And when you look at these, what is in this non-core liability of a domestic bank in an emerging market, you see that the big part is going to be this green bar, that's payables to bank. But that's payables to international banks, not payables to domestic banks, because when you look at the right, when you do the payables to domestic banks, it should be all Turkish lira. You can see that the Turkish lira part is very little in red. The big part, the blue, is in dollars. I say it affects, but it is mostly dollars. It is paid to the international bank. And that's why, this is now coming back to the policy implications. In a fast-growing episode of an emerging market that borrows internationally through global banks and global financial intermediaries, but mostly banks, you are kind of restricting dollar borrowing is not going to do anything. If you look at the loan growth during Turkey during this period, actually the Turkish lira loans grow faster than FX loans. And that has to do with the fact that because now they are cheaper. During this type of fast growth episode of emerging markets where they can borrow a lot from international banks, UIP premia, uncovered interest rate premia, or what is basically known as the currency risk premium, goes down. That means, they can actually borrow more in Turkish lira and less in dollars. So you can see here this perfect correlation between VIX and the UIP premium of Turkey. So that means during bad times, in terms of high uncertainty, recession everywhere, that means it is going to be even more expensive to borrow in Turkish lira and cheaper to borrow in dollars. Whereas in the good times, when the country is growing, when there's low VIX, in terms of like uncertainty in the world, it's going to be actually cheaper to borrow in Turkish lira, which propels this Turkish lira borrowing over the FX borrowing. And my final figure is from Chile, just to tell you that actually emerging markets are similar. So this is during the COVID episode, so you can see the huge drop in the EPFR flows. These are the fund flows to Chile. Now I'm looking at actually the bonds together with the banks, and you see how the UIP premium shoots up. When the foreign financing dries up, it's actually not only hard to borrow in dollars, but it's even harder to borrow in pesos, and that's the both domestic and international currency risk premium, because you can borrow also in different currencies in domestic banks. And the governments actually can offset that. This is the policy implication. So this is what happened to Chile before and after this COVID sudden stop shock. This is March 2020. It was a sudden stop shock to emerging markets. You can see that small firms went fully from most domestic and some foreign, the first bar, to fully domestic. When it is blue, they went to fully domestic, where the large firms, the third bar, didn't change the composition of international versus domestic funding. Why? Because the government put out all these policies that reduces the cost of domestic borrowing to help these smaller firms, SMEs. Okay, to conclude, the links between corporate debt savings and macro and global imbalances, it goes through several channels. And the key takeaways here is that corporate debt impacts macro aggregates such as employment, investment, output, during boom bust cycles and after financial crisis. I don't have time to show you everything, but here's predictive power for crisis, sluggish economic growth afterwards for the countries that really have these credit booms going through the corporate debt. Aggregate employment investment outcomes are linked to SME debt, and here debt contracts play an important role, where SMEs borrow more through earnings type of collateral than real estate. Corporate debt dynamics are linked directly to global imbalances and international policy transmission. And then the corporate debt in other currencies is a major driver of the crisis, though it is going to be harder to borrow in your own currency during bad times. So here there is a room for government policies, especially to help the more vulnerable firms. Thank you.
So I'm going to talk about, I guess this only goes housing markets, leverage, and policy design. So housing crisis, while they appear as price crashes, you can think mainly their underlying cause is coming from leverage and some balance sheet fragility. You can think of three channels. There could be others. The household leverage, clearly household debt, how that is playing out. Developer leverage, this is what I will focus on when I come to India and China. And institutional weakness, that if we can increase transparency on enforcement, how that will actually help these markets. And then I'm going to talk about policy design. And here you can think about Atif's work that they have discussed in their book on policy design. So I'm going to focus on three countries. The US, where household leverage was a big issue in the mortgage market. The crisis was essentially driven by borrower defaults and the securitization frictions. And then I'm going to talk about China, where they essentially learned from the US and realized, okay, we'll fix these problems that the US household debt was having. And they left the door open for developer leverage. And then I'm going to show you what developer leverage has done in the Chinese market. And India, that is learning essentially both from China and the US and saying, okay, we will fix all these problems through transparency and accountability. And that may cause other problems there. Okay. So if you think about the household market, I'm not going to go, for the US market, I'm not going to go in the past describing the crisis, but think about the policies that the US enacted after those policies. The crisis happened, house prices were falling, that created widespread negative equity. There were income shocks that were coming from job losses or rate resets, and that exacerbated the foreclosure cascades. Essentially, the US went out and said, let's come up with some policies to kind of take care of this. HAMP was one of the big policies that was essentially designed to create loan modification programs to help distressed borrowers. HARP was another policy that was essentially allowed to get refinancing for the negative equity homeowners, so that both these policies were essentially designed to alleviate contract frictions, otherwise that would have were preventing the private sector to play a role in this. The HAMP program, which was a pretty big, significant program, $75 billion, one of the biggest at that time, was giving direct subsidies to homeowners through the mortgage modification program. It was pretty large scale. The rationale was essentially there was negative externality to foreclosures because of this, and there was this securitization frictions in renegotiations. They had elaborate selection criteria, who was eligible for this, and we use this in the work I've done, trying to show how does the HAMP program actually work. There was a criteria on property size and property amount, home ownership, residency status, and so on. And what we looked at this was the selection, treatment, and control group who were treated to be part of the modification program and who were not treated. Essentially, they are pretty similar groups, but the program actually worked pretty effectively because both the trial mods and permanent mods actually went up significantly right after the programs. We also looked at if there was a substitution between the private mods that the banks were doing anyway versus the HAMP mods, and essentially there was no substitution away from private mods. So the program actually did the job. If we look at the HARP program, which was allowing, giving incentives to the banks and also consumers to refinance their mortgages, these are people who are actually having very high LTV of above 100%, which otherwise would not have gotten a refinance. The program was allowing them to go through this refinance program. In essence, there were around 3 million borrowers who refinanced their mortgages in the HARP program. They were restricted mostly for agency loans. Majority of the loans were issued through the agency. They had very high LTV in these loans. The incentive for the borrowers and servicers was that refinancing will allow them to get lower rates and increase their disposable income. That could have some macro implications on the economy. And the second argument for the servicers was that, look, you will use this, and then you can still securitize some of these loans. Okay. If we look at the data, actually, the program worked well. It reduced the interest rates by around 30% that these HAMP loans were getting. Then if I look at the macro implications, consumers save the money through these loans, and they use this money essentially to go out and consume. One way you can look at the data is they went out and spent on auto loans. Okay, so what we learned from there, essentially these two policies that were implemented in the US, both HAMP and HARP, they reduced defaults and essentially stabilized their neighborhoods and the economy overall. So the way I think about it, these shocks help the Asian economy, especially India and China, realize, okay, the household leverage is a serious issue. So we need some macro-prudential policies, either through DTI, LTV requirements, to lower the leverage of the consumer. But what they forgot or didn't think about is leverage of the developer. In these economies, the developers play a big role in the housing market. They are heavily leveraged, and most of these developers rely on pre-sale market. So most of these houses are pre-sold, then they go out and start building this. This takes 3 to 5 years to develop it. In those 3 years, if there actually delays or defaults by the developer, the consumers end up defaulting on their loans to the banks, and that perpetuates a crisis. Okay? So this creates delays and defaults of the consumers. This actually delays the mortgages, and foreclosures appear because of this. A classic example of this was a Evergrande developer in China that actually went through insolvency and restructuring around 2020. That was a serious issue in China. Subsequent to that, if you look at in China itself, land transactions, house prices were going up, but actually land sales dropped precipitously during that time. Okay. So we actually looked at the policy that the Chinese government came out around that same time, was this 3 red line policy. And essentially the idea was of this policy to kind of deleverage the developers. They said, look, liability to asset ratios will be restricted to under 70%, net gearing ratio or some leverage ratio will be under 100%, and cash to short-term ratio will be over 1. And we kind of looked at who this policy applied to, and most of this policy was applying to non-SOE developers. SOE developers were exempt from this deleveraging policy. So we looked at in different setting what was happening to the developers' view, developers who were constrained on this policy versus non-constrained on this policy. So we find 4 things essentially. Non-SOE developers reduced land purchase by around 50%. So quite a big shock. Land developer, these non-SOE developers said, we are just not going to be in this market anymore. There was market restructuring because significant decline in non-SOE market share, non-SOE developer market share. There was spillover on the housing market because there was a decline of home sales by around 20%. And this actually intensified, all of this intensified as this rolled out. If you look at the regression results, you can see what was happening to non-SOE developer outcomes in terms of mortgage housing outcomes, housing developments versus SOEs. You see stark differences. Now, you might think, what was the implication of this? This should reduce foreclosure outcomes, but we still see large foreclosures in China. I mean, I don't show you the data before 2000, but if you look at data before 2000, foreclosures are very small, in 4,000 to 5,000, but after this, they have jumped quite significantly. Okay, over this 5-year period. If I look at residential foreclosures are quite high, even relative to others. Our time series will show you what is happening to residential versus commercial. They're actually growing. Now, you might say, look, they implemented this 3 red line policy. Why are we still seeing large foreclosures? The policy is only applicable to non-SOE developers. So that's one issue, that they only try to fix this loophole for one segment of the developer population, but the other segment was giving out much more loans, and that's what is causing a lot of this foreclosures in the Chinese economy. I mean, this is a massive data set. We are still working and collecting and cleaning and going through it, and most of our results show that these foreclosures are coming from loans that were made from SOE developers, because those were unregulated at that point. Now thinking about what is happening in India. India actually looked at both what happened in the US and said, okay, we want to deleverage the consumer, but looking at China, they also realized, look, we need to kind of fix the developer market. They didn't really have a crisis in terms of foreclosures, but they were anticipating it. So they said, look, we need more transparency, escrow rules around developers, more stronger enforcement of what developers do. This will help improve buyer protection through reduced delivery risk that they're giving out this housing, and hopefully stabilize housing access. So in the paper, we go through, but here I'm just highlighting the results that we find in the paper, that what this policy essentially ended up doing, there's more transparency and accountability of the developers in India. It increased the loan amounts that were being issued, and number of loans also, both extensive and intensive margin, this was helping. There were new net borrowers that were coming into the market. Existing loan borrowers did not get affected, but new borrowers came in. The type of borrowers, there were underserved borrowers, especially women and low-income borrowers, because the new developers that came in because of this transparency policy were in tier 2 and tier 3 cities, who were then catering to new markets. So essentially, the banking system kicked in at this time and realized now there's more transparency. Developers are less likely to default and go out of business. So I'm going to give more loans to consumers who are looking for availability of housing. This graph essentially reinforced what I just showed you in numbers, that what happens to lending at that time. If I look from the supply side, if you look at what is happening to developers, number of unit size is actually going down. Price per square foot is also going down, and the quality, there is an index in India of developers, and the quality of this developers who are subjected to this criteria, there was a cutoff on which developer would be subject to the RERA policy and which was not. You can see that the quality of the developers who are subjected to this regulation is actually getting better. If I look at what is happening in terms of what kind of housing projects these developers are making now, they are making more affordable housing, and that's where they are also, more affordable housing is coming up, prices are going down for them, they're increasing luxury housing as well. there is increased competition because now there are all these new developers who are coming in, and profitability of these developers is essentially going down. These are essentially regressions that reinforce, graphs that reinforce what I just kind of showed you in housing. So the key takeaway for me is this, this regulation, this expanding accountability of developers expands home ownership by unlocking this credit that was not being allocated or not being allocated to the underserved population or groups in India. It enhances this transparency and builds trust among the buyers and also among the for the banking system. Okay, so policy implication of clearly institutional reforms that can open up, and this is true for most of Asia or other developing countries where there is lack of transparency in the housing market. The more transparency we bring, that will help new homeowners and existing homeowners to reduce, expand homeownership and also reduce default. So I've kind of gone through 3 different markets. The US housing market, where, deleveraging was important, and that actually through the HAMP and HARP program, they actually took action, but the action was too late. This was done after the crisis happened in terms of policy. In the Chinese market, they were taking action, but they were taking action on a select group, not the entire market they were trying to fix, which was looking at the developers, SOE developers, and non-SOE developers. They only focused on one. India did take action on all of these things, both the consumer market and developer market, but obviously we don't know, what can still come about. But up till now, what we find is that, look, a policy action or a regulatory action can actually help these markets significantly. So the takeaway for me is, look, housing cycles are inevitable, but crises are not. So if we actually do things, design policies up front to kind of take care of these shocks, we are better off. I'll stop here, since I have 15 minutes.
So, Şebnem, you made a very interesting point and outlined what's going on, but you didn't provide a policy recommendation. Can you give us a short policy recommendation? What are the conclusions we should draw as a policymaker from these insights? And for Sumit, I was very fascinated that China was learning from the US and then India was learning from China. Do you see any ways where the US is learning from India and China? So do we have any developer regulations that are updated in the United States because of the experiences in Asia?
Who do you understand?
Let's go the same order.
Is this on? Okay. Whether we can get rid of liquidity regulation. So it's a very important question. I think if you look at the research that's been done, so for example, from the Yale program on financial stability, Steve Kelly and some co-authors have looked at a range of emergency liquidity interventions and found that, in most of these cases, they looked at 23 cases, all around the world, Brazil, Denmark, the US. In most of these cases, these liquidity policies were useful for buying time. And I think also, liquidity regulation can be useful for buying time, but ultimately can't be seen as a substitute for capital regulation. There's some other work by Matt Barron and co-authors that's looked at some major liquidity interventions in a range of different financial crises that finds that actually, in the short term, sometimes the stock market reacts positively, bank stocks react positively, but actually this is, essentially never enough to forestall, these major crises. Now you could say there's some evidence that points in the other direction. For example, some work by Gary Richardson and Troost in the Great Depression that looks at banks that were in different Federal Reserve districts and the Federal Reserve districts that did more, lender of last resort type lending. There is some evidence of lower failure rates, so that pushes a little bit against kind of the thesis that I'm making. But I think overall, it's sort of a question of emphasis and sort of how we think we can respond to crises in terms of the very successful responses to crises that we've seen in different countries, like, say Sweden in the early 1990s, really dealing with these kind of capitalization issues was first order. So I think that's sort of my nuanced answer to your question.
Thanks.
Okay, so the policy implication, yes, I kind of hinted it, but I didn't talk too much because it's extremely difficult. Why? First and foremost, on the side of corporate debt, there was a lot of emphasis put on the bust side, right? And when things go bad, when there's crisis, especially a group of SMEs, these are the backbone of the economy. Governments rush to help. I mean, we saw this during COVID. PPP program is around the $2 trillion program in the United States. The last one I showed you from Chile, of course, not that big, but a similar program, right? This kind of government like coming with subsidies. What comes out of my research and also others' research on this is there has to be an equal emphasis on the boom side, right? We have to really limit some of this leverage on the boom side. But of course, these are, private firms. I mean, they are not banks regulated. They are not public firms like, with responsible to shareholders. These are like private firms. So how do you limit leverage of a private firm during boom? That's a very difficult question. The way emerging markets dealt with is through the FX side, right? Because that they can still run that through the banks. They can tell the banks like, okay, don't lend or lend up to this much in dollars and euros and all that. But our research showing that that's one policy. It may be a good enough policy, but not a panacea, right? We need to do more deep thinking outside the box on what to do on the boom side. Because also there is this trade-off between limiting corporate leverage during boom and not limiting access to finance to small firms, right? I mean, again, if these SMEs are, backbone of the economy, engine of growth, engine of innovation, you also don't want to limit access to finance. So it's a very, very difficult problem because you go back and forth between this, access to finance and then kind of the limiting the leverage thing. And that's where I think this debt contracts, who is the lender, what is that relationship, all these things play an important role that I think we need to do more work. But this is the general gist of it.
I think in housing market, I'm not sure what America can learn. I'll give you a story in a minute. But I think where America could learn from what is happening in Asia is in the financial technology world. I mean, this is where China and India has done amazingly well in terms of alternative finance. And US is far behind there. And seeing what the technology they're using, how they are doing UPI in India, universal payment systems, or lending in China, I think and the pitfalls and the problems they are facing, US can learn. In terms of housing, I remember when I was at the Federal Reserve here, and Pulte used to be on the board at the Chicago Fed, and somehow I got into a conversation. He gave me all the Pulte data. I wanted to understand what is the role of developers in the crisis. When I wrote the paper, they shut down my paper. So clearly, they don't like us to discover what is happening in the developers, what they're doing in the US.
Any questions, Harold?
So I had a question to Emil. I wondered in terms of the use of this long historical data. Obviously, it's very, very fascinating. But I wondered how much you think that it really is relevant to discussions of what's been going on in the last 30 or 40 years, in the sense that financialization has made the products much more complex and much more difficult to value. So that when Bagehot was writing in the 1873, it's very, very easy to distinguish solvency and liquidity. When you're dealing with Lehman in 2008, nobody really knows that, and there's a long controversy about Lehman, whether it was insolvent or whether it was just illiquid. And I wondered whether part of the explanation isn't also given by the story that you put in about the wedge that you get from the liquidation costs. Because in the 19th century, you liquidate something, it's very simple. You sell a bit of property and you sell some of the inventory and so on. Liquidating Lehman takes years and years and years, and it's still not actually complete all over the world. So the costs are much, much higher, and that might also explain one of the differences in terms of the difficulty of using this historical material.
Yeah, great question, Harold. I mean, I think you're getting at sort of the basic challenge for banking, which is that banks are opaque, bank assets are hard to value, and so this line between solvency and liquidity is difficult. That's why I said recovery rates can give you some sense. And kind of to answer the second part of your question first, we actually spend a lot of time reading and trying to understand what receivers, how they actually manage these assets. And what we were concerned about was, for example, that they would go out and really liquidate, fire sell these assets, like, exactly like would happen in your, Diamond Dybvig style model. And what we learned actually through a lot of different historical research that's looked at supervision and looked at receiverships is that actually receivers typically would hold these assets for several years. So there's lots of evidence that, for example, in the Great Depression, receivers didn't liquidate real estate assets because they knew that they wouldn't be able to get good prices for them, and they held them. And so I think then that raises the question of, given that these were often not very well managed institutions, how much value is the receivers going to destroy? Which actually they have a lot of expertise dealing with these types of banks versus the bankers themselves that have taken a lot of risk. So we have a lot of discussion in our paper of how to think about these parameters, this rho and v, and really what we can make is conditional statements based on your prior and based on some suggestive empirical evidence of how long and how much loss comes from these receiverships. In the pre-FDIC period, the average receivership would still take about 5, 6, 7 years, to liquidate. So that's sort of the typical duration of these assets. Whether banks have become more opaque over time, I mean, on the one hand, yes, perhaps, these financial products have become much more complicated, but at the same time, we also have much more data, much more market information to value these types of assets. And I think, other banks also have this information and it moves more quickly. So I think it's an interesting empirical question, but I'm not so sure I would kind of immediately just conclude that, well, banks have become more opaque and more difficult to value than they were in the past.
Any further questions? Yes, the gentleman.
Professor Agarwal. Oh, thank you. For Professor Agarwal, I was wondering, in India, you mentioned that there were drastic implications of their policies. How did that affect outside of housing sectors? And could we also see changes in money lending or non-institutional finance?
You mean the policy I'm studying, the RERA policy, which was essentially a policy designed for real estate developers.
Right.
So I'm not sure the externalities that you have in mind, what the externalities could be. We didn't look into it. But I think India is going through a lot of reforms right now. In the financial sector itself, I've looked at what is happening in the fintech world, in the payment world, how the payment system is being changed, and the implication of that on spending, consumption, investments, lending, and actually even the growth of infrastructure. That is also changing what is happening in bank lending in India. To your question, I don't know. I've not looked into that, the RERA policy and its implication on non-banking world.
Thank you.
Jeff.
Hi. Emil, so far as I could tell, the speed of your presentation, I didn't hear any distinction between your cases that took place in kind of normal times and the incidents that took place in systemic distress. And it seems to me that's a fundamental issue. Systemic distress destroys asset values, makes a lot of people look insolvent who wouldn't be in normal times. Is in your work, do you do anything to look at that distinction?
Yeah, that's a very good question. And we do. So let me answer in two steps. So one, on the run side, what you see is that if you want to understand which banks are subject to runs during quiet times, fundamentals do a pretty good job. But during times of systemic stress, that's when people get jittery and depositors get confused, and even good banks can be subject to runs. And that's where a lot of these runs without failure are happening and are being resolved through some of these other mechanisms that I talked about. The most extreme being suspension of convertibility, where banks would stop paying out partially or fully deposits. And then examiners would come, often in conjunction with the clearinghouse, and figure out whether banks were solvent or not. Then to the second point of your question about sort of the GE effects that come through basically fire sales and asset losses through price effects, that's absolutely something that's happening. So you see, for example, when banks are subject to runs, they're cutting the amount of cash securities that they have, and so that's pushing down prices. And there's also other types of contagion effects, because you can, for example, see a bank is more likely to be subject to a run if other banks in the nearby area were subject to runs, just because people get jittery, and so those effects kind of multiply. So that's, I think, an important caveat to what we're saying. Some of these GE effects that are kind of happening through fire sales are important in crises. The question becomes sort of how much of that is due to fundamental insolvency, that is leading banks to fire sale assets, and how much is being made worse by runs. And given the ability to freeze the balance sheet, or to put in additional liquidity, or deal with runs in other ways, I think it's more about the initial fundamental solvency rather than the runs.
Can I just follow up on that? Would you say that when you look at liquidity, you would like to look at systemic liquidity much more than bank-specific liquidity? And if you have liquidity requirements, it should be bank-wide, sector-wide rather than a specific banks. Would it go so far?
I mean, it seems quite clear that it's much more difficult to deal with these systemic liquidity issues than to deal with bank-specific. Bank-specifics, banks, including some of your work on 1930s Germany, banks are pretty well informed about which of their peers are in trouble. So if there's enough liquidity overall, but you just need to kind of reallocate it, then it's easier to deal with those sort of issues. If you have aggregate liquidity issues, then perhaps some of these issues become more complex. But I think it's still, you look at some of the evidence on these aggregate liquidity interventions, I think it's the emphasis is still sort of, I would say, kind of been weighted too much toward the liquidity side and not enough towards kind of these fundamental issues that comes from the credit boom that Şebnem also talked about.
Moritz?
And both of you highlighted the bank side of the credit boom and to small companies, in particular you, Şebnem. And then in recent years, I guess, I've seen a boom in credit expansion on the non-bank private credit market that also goes to SMEs. Do you think this changes fundamentally how credit cycles now transmit, or not?
So, okay, we definitely need more research on that, because this, non-bank private credit overall is kind of a rather newer area that a lot of people working on. But of course, it's hard because it's very opaque. We don't have data and all that. But there is this interesting link now documented by David Schaffer's work and others, that there is this link between banks and non-banks, right? So it's almost like a triangle. So the banks can be lending to SMEs, or banks, after the heavy regulation on them happened after 2008, lending to non-banks, and non-banks lending to SME. But still, you have these like closed loop, right? At the end, the SMEs are the riskier borrowers. If the banks cannot do it because of the regulation, then the non-banks are going to do it, but the non-banks are borrowing also from the banks. So again, we need more research, but some of it should be in place. And also we know this from emerging markets, right? I mean, this non-bank phenomena is kind of really growing very, very rapidly in advanced economies, but it has always been the case in emerging markets, because not only bond markets not developed, banking systems also not that developed. So there's always this kind of a more general financial intermediation that is kind of fragmented and segmented in emerging markets anyway. And in general, the similar patterns should stay. But we do need more work, definitely, and more data on the non-banking side.
Can I follow up on this concerning looking a little bit more fintech and digital collateral?
Yes.
Did you look at that? Like if I look at China, it's mostly through the payment system. You get some digital collaterals out of that. Is there any insights you can draw perhaps from other papers more on the digital side, whether we see a very change in SME lending going forward in the next 5-10 years, especially in emerging economies?
Okay, no, this is very important. I mean, we are now like starting a project on this, like, fintech and the AI, because there's also huge lending now. I mean, huge capital going in the AI. I mean, and there are two sides to this. I mean, it can be the biggest misallocation of capital we are seeing in the last century, or maybe it is the best, right? I mean, so we will end up with one side of this. But the kind of like lending going to these type of tech, digital sectors, and then the payment system. They are related, but they can also be separate issues, right? And we don't know much. I mean, the work I know, we just started work on this, but the work I know of others is during the COVID period, where a lot of actually PPP-based, even the government programs went through fintech, right? Because the regular banks didn't do it, and in fact, there was a whole this mushrooming of this industry through that, which is very interesting, to do the payments, right? I mean, the money is still coming from the government, but just to intermediate. So in that sense, I think this is something super interesting to work on more. Yeah.
Great.
I want to ask a question for Sumit. So you gave a very nice, very comprehensive coverage of 3 different countries. For China, you emphasize the developer. Of course, developer had a very high leverage. So, I mean, actually, China has some regulation on that, right? In some sense, sort of the way it runs make developers a bit like banks, right? So, you know, it has very high leverage. It has a lot of liquidity need. You borrow indirectly through sort of home buyers, right? Just like have all these sort of like depositors in some sense, right? So what's your? I mean, of course, the reason we see all the trouble later is because the local governments are actually behind the developers, because they all have this incentive to see the boom, right? So because they all benefited from it. So do you have some particular? It looks like you have done very extensive look into this. So do you have some policy suggestion on this? Going forward.
I mean, the policy I was highlighting was this 3 red line policy that China implemented to curb the non-SOE developers. Unfortunately, they didn't focus on the SOE-based developers, and I think that was the flaw in the policy design that they did. I think going forward, what China needs to focus on is focus also on exactly these SOE developers who were given a free hand. Essentially, they took over the market share from non-SOE developers, and they're highly leveraged. And I mean, I go to China all the time, and you see these stalled projects, housing projects, and that is causing this cascade of defaults and foreclosures that is happening across the cities. House prices are already falling. I mean, the figures that are written or talked about, they are not even close to how much house prices are dropping. I mean, the man on the street will tell you, look, prices in Shenzhen have dropped maybe around 45%. Maybe that's their house, but anecdotally you hear these stories. So I think there is something that has to be done in terms of policy response by the Chinese government, specifically trying to fix the housing market. I mean, there are other implications of that. I mean, they have to think about the banking sector, how this will affect banking sector, how this may affect the real sector. If they stall completely these projects in real estate, because that could affect unemployment rates in lots of these places.
I want to just comment on, so you mentioned sort of the enforcement of SOE developers not strict enough, right? But given sort of the crash, which are already there, somebody need to buy out the others, so they're in trouble, the non-SOE developers, right? In some sense, sort of the SOE developers are the kind of the buyers. So if you sort of tighten on them as well, then there's no buyers, right? So in that sense, I think the maybe the selective sort of enforcement. This is the motivation.
I'm not sure. You are actually having a view that the government thought through about this. That look, let's keep these guys separate, and this way at least we'll cushion the flow. And what I'm showing, the foreclosures that are in the millions now in China, they could be 2 million, and now it's only 1 million because they curbed the lending to or leverage to the non-SOE developers. But 1 million is still quite high. I mean, there is a huge negative spiral because of this. I mean, the other properties are going into foreclosures. I'm looking at a lot of the data and what is happening to resale of these foreclosed properties. And the haircut on these things is around 40%. And that has huge implication to equity or on wealth, the housing wealth that is being depreciated in this place.
John?
I had a question for Şebnem and also for Emil. So Şebnem, on your FX point, I think you just showed that there was a correlation, but if we look historically, big corporate lending booms have also been periods when the domestic currency was also appreciating very, very strongly. I mean, Japan in the lead up to the 1990 crash, I think is a very good example, but especially in the emerging markets. I think there's probably it's very important some causal mechanisms there is also. Maybe you can elaborate on that. For Emil, the evidence is really very interesting, and you've got this very comprehensive take. What I missed was the period before the Fed and the period after the Fed. It does seem that you just flashed that chart. It did look as if there was some differences there, and things have really progressed a lot recently. I mean, Silicon Valley Bank was an extraordinary run. We have the liquidity coverage ratio, which is all calibrated on GFC, but of course, that all the money went out on that Thursday lunchtime. People were having lunch and then they withdrew all their money. It's like, big chunks of deposits sort of flew. And I don't think any regulation is going to take care of that. So I think, and what happened, we had the central bank coming in. And the discussion now is all about, should we have some kind of pre-positioning of collateral at the central bank? So wonder if you could sort of bring it right up to date. What does your work say about SVB?
Do you want to go first?
Yeah, sure. No, this is an excellent question. In fact, in international finance, until Huyun's work, we focus extremely on the bust side, right? Like on the crisis side, when the crisis happens in the emerging market, the currency collapses, so you have dollar liabilities, you have peso assets. There's this huge balance sheet impact, and like everything collapses, right? What Huyun's saying is, in fact, his work made us realize there's this huge part that works on the boom side when the peso is appreciating, right? So, and that fits perfectly with my collateral story. So a lot of these small firms in emerging markets, there are going to be many of them, they are going to borrow with collateral. In fact, you saw that actually it is the very, very large, Amazon, Google's type of firms that don't need that. Those guys are going to borrow with collateral, and during a boom period when interest rates are low and then all the peso assets are appreciating, exactly as you're saying, of course it is much easier to borrow. So you're exactly right. So the causality here, it's hard to pin down without having microdata on all these dimensions. But I believe both the interest rate side of the story, where it's a boom period, like rates are low, you can borrow in pesos, and peso assets are now valuable, they can be better collateral because peso is appreciating. They are I think equally important, right? So I fully agree.
Yeah, I liked how you coupled your question with kind of thinking back to the start of the Fed and then going to today. I think actually starting first with the 1920s is very instructive, because in the early 1920s, you had a very severe economic downturn, major agricultural recessions, lots of bank failures. What did the Fed do? Massive discount window lending. Actually, if you look at the amount of liquidity provision that was happening during this period, there's so much liquidity provision that's happening to banks that ended up failing. People have even speculated that actually contributed to some of the later real estate bubbles that happened in the mid-20s. And so in the middle of the 1920s, really without telling anyone, the Fed drastically changes course. And that's sort of where stigma at the discount window sort of seems to come from. And that's where you get the depression, where no one really understands, is the Fed going to provide liquidity or not? Then we've added sort of more layers of liquidity protection. So after that, we've, federal deposit insurance in 1934. That's clearly changed the nature of how banks fail and the speed of failures. And now what you're seeing in kind of modern failures is that failures are typically a supervisory decision, with the exception of these really big failures where you have lots of uninsured depositors that can run immediately. And so that slows things down a lot. But it does also create other problems that we of course are very well aware of, other costs. And so maybe you buy time, but you also create the scope for kind of more more gambling, more mistaken actions, and so on by banks. Then going all the way up to SVB, I mean, in some sense, I think that some of the policy discussion post SVB is very interesting in light of these debates, because what's your take on SVB? Well, if you look at the asset losses that they were probably kind of marginally insolvent on a mark-to-market basis. It depends on how you value the the deposit franchise value. There's a lot of debate about that, but I think sort of overall, why should depositors stay at 0 rates when all of a sudden rates have gone to 5%? I mean, should we expect depositors to just subsidize banks when rates go up all of a sudden? They can do that for some time, but I think in the end, SVB, yes, it happened very quickly, but I think on the realm of solvency liquidity, I think it's actually depositors ex post exerting discipline a long time after these losses have actually been realized. And maybe that's kind of one of the more marginal cases, the 8 to 20% that I was talking about, whereas the typical bank failure, even post-deposit insurance, has losses of somewhere around 25 cents on the dollar. If you look at the data from the FDIC, I think the losses for SVB are actually going to look somewhat lower, kind of to that argument. So yes, things can sort of move faster. We can put more liquidity provision, we can prop things up more and more. You say, no policy is going to prevent these runs, but I think if you had, a bit more capital, that would certainly slow them down and, require more losses for them to happen. And I guess also, I mean, I like study financial crises. In some sense, maybe you could say I like runs, but the question is, is the goal really to have 0 runs in our system? I mean, is that there's also, of course, runs are costly, and if we could always close banks in an efficient way without having the runs, I think we can all agree that would be much less costly. But I think runs impose discipline on banks, but also on regulators and on supervisors. And so, I therefore think that this move now towards propping everything up with liquidity. Harold mentioned Badget. Not doing it at penalty rates, but at subsidized rates, that's going to potentially lead to its own costs down the road. But we'll see about that.
But do you have a take on the pre-positioning that the banks, because the runs are so fast, that the banks have to put collateral up front before they get some lending from them?
I think that can buy time. Yeah, I think.
So you're in favor of that?
Sure. Yeah, I think that can buy time, but of course there's also costs to these types of policies. But this is not the what's going to prevent these types of failures from happening, in the first place. I mean, the SNLs had massive amount of time, to rescue themselves. They couldn't. Banks in the 2008 crisis, most of them didn't go out with a run. They, were closed 2009, 10, 11, with big losses. And okay, some of them were able to buy time and become solvent again. But often depositors are actually slow to react. We have kind of these models where once you enter the crisis zone, well, depositors can jump kind of immediately. But I think all of this evidence on the predictability of crises, the predictability of bank failures, the role of credit booms says that actually usually these types of things happen quite late. So then the question is, why doesn't policy intervene before?
I guess the advantage of this pre-positioning is that you have to put up the collateral. You might run out of collateral even before the run occurs. And that slows the bank down from expanding or giving more loans early on.
Sure, yeah, of course. There's also costs to that, right? I mean, all of these liquidity policies also have actual costs. Capital regulation also has costs, but we can debate about what the order of those costs is.
Gentleman at the back.
Hi, a question for Professor Verner. You showed on your slide that one of the best predictors. Oh, thank you. A question for Professor Verner. You showed in one of your slides that one of the best predictors of crisis is the sectoral composition of credit and whether there is a lot of credit expanded in non-tradable sectors or the housing sector. And that creates these feedback loops of higher asset prices, banks that seem solvent and more credit expansion. I'm wondering, in the question of how to address these asset feedback loops, is there value in being clear on whether banks are simply intermediaries or they can also create liquidity and expand liquidity and create deposits? In these questions of what do banks lend for and whether the regulation should be just microprudential or systemic, do you think there is any value on whether banks are simply intermediaries or whether they can also expand the money supply and create deposits when they make loans? Thank you.
I mean, yeah, I think it's pretty clear during these major booms, sort of banks expand and their leverage also expands. And one way, Hyun's work going back shows that often the way that they fund these is it's hard to get deposits to finance a major, lending boom where you double the size of your assets. So you go to wholesale funding markets, you get different forms of non-core funding, you expand your leverage, and that's how a lot of these booms are are financed down the road. And then if you're lending against collateral, well, often that's going to be cheaper from a capital charge perspective. So that sort of allows these feedbacks to kind of not be curtailed. So yeah, policies, simple leverage ratios on banks, and also restrictions on borrower leverage that aren't focused on LTV, that have the prices that are bubbly during the booms, but focused on sort of debt service measures might be useful kind of to tame these types of booms.
Oh, gentleman at the back.
Thank you all so much for coming. My questions for the panel generally. My takeaway from your remarks are that leverage and credit booms are very important for trying to identify future incoming financial crises. I'm curious to hear about what role you think monetary policy has to play in all of this in terms of it facilitating some of this. And I'm curious if you then feel that central banks should expand the purview of trying to consider some of these other variables in addition to inflation and employment. Thanks.
So let's use this as a final round, and then we conclude in 2 minutes. Who wants to start?
Okay. So I think banks are doing that not through monetary policy, but through macroprudential policies, central bank. So if I look at in China, India, Singapore, they have very strict macroprudential policies on leverage, household leverage, on credit cards, on housing, what the debt-to-income ratio should be, loan-to-value ratio should be. So I think that's already happening. I'm not sure how to incorporate that into the monetary policy, but I think there's a channel through which central banks are already playing a big role in this.
No, it's exactly. In the United States, they are not connected, right? Monetary policy and the macroprudential. But in all other countries, actually, this is known as monetary policy framework, and monetary policy framework is the interest rate policy, inflation targeting, and all that. And then there is this whole macroprudential dimension, and that's about like these are countercyclical policies. It's about taming the cycle. But monetary policy, of course, has a very important role, right? Both in terms of like I don't want to say it's not causing the crisis, but if you look at the episodes of a lot of crises outside the United States, they affiliate with the periods of the monetary policy tightening of the Fed. The only time it didn't happen is actually post-COVID inflation when Fed started tightening in 2022. That is the only episode we have where it didn't happen. But if before you go back to the 1970s, all these episodes are associated with that, because that's of course the global borrowing cost. But I think here the important thing is try to manage the cycle in a countercyclical sense and use the macro-prudential policies. At the same time, it goes to the bank regulation too. This goes back to Juli's question. Like there is no way you can prevent something like SCBB when everybody's like taking out their at lunch. Yes, but also a question should be asked: why on the asset side during a monetary policy tightening cycle you have these assets, right? So that, again, is something about regulation and supervision. So there is a lot of integration between the two in other countries, less so in the United States, but there is definitely, obviously, links between the banking regulation, supervision, and the monetary policy in the US.
Yeah, I would just say there's actually 2 excellent papers that came out roughly at the same time, one by Richter and Jose Luis Pedro, and another one by Grimm, Jorda, Schuller, and Taylor. And they both show a very simple result, which is if you look up to financial crises, monetary policy rates, simple policy rates, or sort of some deviation from a Taylor rule, show kind of this striking U-shape where monetary policy looks quite easy, and then they get concerned about the boom and they start to tighten, and often that actually ends up sort of precipitating the crisis. And that, I think, connects with some of the anecdotes Şebnem was talking about. So, often monetary policy is actually the boom or generating the boom. So, we're at this next financial crisis conference at the ECB, and Raghu Rajan was talking about these papers, and he said, maybe one thing is monetary policy should try to do less. Maybe sometimes we shouldn't, we're generating these booms and then we're trying to curtail the booms. That's sort of one question. It's a difficult question, though.
With this final statements, we conclude the panel and give a big round of applause to all 3 of them.